This is the performance summary for the relative strength strategy for the week ending Jan 30th. Let's start by inputting the account balance into the spreadsheet. So month to date January, the strategy is up 10.8%. And this is despite the huge sell-off we saw in silver yesterday. So currently the portfolio still holds 3 metals related positions. First one is FSAGX, and that one, the total gain so far is up 11%. And FSAGX is the Fidelity Select Gold portfolio, holds gold mining stocks. The top 5 holdings are Newmont Corp, Agnico Eagle Mines, Franco-Nevada, Wheaton Precious Metals, and Barrick Gold. And this is how FSAGX has performed over the past 3 months. And we can see the huge sell-off that happened in mining stocks on Friday. And despite that, we're still up on the month. And this is the past 3-month chart. And over the past 1 year, this is how it looks. So it's still a pretty compelling holding. And so yeah, it's still one of the top 3 picks for the relative strength ranking algorithm. Okay, the next one is GLD, the gold ETF. That one, since we started holding it, is up 9%. And this is how gold looks recently. This is the start of January, and this is where it's at now. And this was the big sell-off on Friday. And over the past 1 year, this is how gold looks. And the third one is SLV, the silver ETF. And even with the 30% sell-off on Friday, it's still up 9% for the month, 10%. And let's look at the chart. So this is a 3-month chart of silver. This is the start of January, and this is where it's at now, and still up on the month. And this is silver over the past 1 year. So it's still very much in an uptrend, even with the volatility. And I have a chart of silver, cash silver, going back to 1973, 72. So more than 50 years of data here. And we can see that the recent run-up in silver does happen periodically. Last one was around the subprime crisis in 2008, 2009 timeframe. And the one before that was in the late 1970s and early 80s. And for those of you who are very much watching the movement in silver and think it's a good long-term buy and hold, I would caution against doing that. These commodities are not really like equities. There is a mild upward drift over decades, but it can also go into multi-decade long drawdowns once these huge run-ups happen. And I think we are experiencing one of those times again. So I would just say be very cautious in buying and holding commodities. Okay, so let's input the current balance into the cumulative tab to see how it's performing since we went live. So since we went live with the strategy at the start of June of last year, it's up 54.1%. And this is how the actual equity curve looks. And now I'll mention a risk management piece that I've added onto the strategy going forward. Because of the extreme volatility that we've seen in the metals, I thought this was a prudent thing to do. The ranking algorithm has not changed. The strategy is exactly the same as it was before. And the market regime risk management has not changed. And that's where there's a 50% reduction across all assets when the S&P 500 is in a bear market condition. That's still the same. The additional risk management layer is an asset-based volatility reduction. When the historical volatility of one of the traded assets exceeds 50%, then the strategy will start to incrementally reduce exposures. And so here's a comparison of the performance and risk metrics of the old version and new versions. So the old version's annualized rate of return is 18.3%, whereas the new version, with the additional reductions in exposures, the ROR comes down to 18.1%. So it's virtually the same. And of course, that's comparing to the benchmark S&P, which is 9% annualized. Max drawdown doesn't change. Sharp ratio doesn't change. And the return to drawdown ratio is about the same. So not a huge change in terms of the statistics before and after, but qualitatively, I think it's a very prudent thing to do, because for the Feb allocations, we're still holding silver, but in the old version, we would have been holding 33% allocation to silver, but in the new version, it's going to be about 17% allocation to silver. So I think it just makes a lot of sense. And let's look at the performance of relative strength going back to 1991. And this is the current version of the strategy with both risk management mechanisms in place. So the annualized return from 91 to present date is 18.1%, whereas for the S&P 500 benchmark, it's 9.1%. And year to date, the strategy is up 13.1%. And here's the back-tested equity curve of the strategy back to 1991 compared to the gray line, which is the S&P 500. So if you'd like to learn more about relative strength, or you'd like to sign up for my Signal service, where I email you the mutual fund and ETF picks directly into your email inbox on a monthly basis, please visit my website at returnstream.com. Link is below. Thank you.